An IPO is a major milestone for a company in India. It marks the transition from a private company to a publicly listed one, bringing opportunities for growth, visibility, and capital. But how long does it really take for a company to go public? Let's find out. An initial public offering, or IPO, is when a private company offers its shares to the public for the first time. This helps the company raise funds for growth, expansion, or even to repay debt. But the process is not simple. It involves planning, regulatory approvals, and time. The IPO journey in India takes around 6 to 12 months on average. This depends on how prepared the company is, the time taken for regulatory approvals, and current market conditions. The first step is pre-IPO planning. The company checks if it's ready financially, legally, and operationally. Then, it hires advisors like investment bankers, lawyers, and auditors. A detailed due diligence is done to prepare for filing. Next comes SEBI filing. The company submits a draft red herring prospectus, or DRHP, which outlines business and financial details. SEBI reviews the draft and may ask for changes. This process usually takes 3 to 6 months. Once SEBI approves the draft, the company goes on a marketing campaign called Roadshow. Here they meet with potential investors to pitch the IPO and finalize the price band based on feedback. After finalizing the price band, the company files the red herring prospectus, or RHP. This document contains updated information, including the number of shares, IPO dates, and pricing details. The IPO then opens for bidding, usually for 3 to 5 days. Investors place bids within the price band. This includes retail investors, high net worth individuals, and institutions. Based on bids received, demand is analyzed. After the bidding period ends, the final price of the IPO is set. This is the price at which shares are given to the bidders. If demand is high, the price is usually at the upper end of the price band. This final price is uniform for all successful bidders, regardless of their individual bid. Finally, shares are allotted. If oversubscribed, retail investors get allotment via lottery. Shares are credited to Demat accounts, refunds are issued if needed, and the company is officially listed on the stock exchange. To sum it up, the IPO journey in India involves planning, SEBI approvals, roadshows, investor bidding, and listing. It's a long but structured journey to enter the public market. Ready to invest in IPOs? The first step is opening a trading and Demat account. To be IPO ready, click the link in the description below. Happy IPO investing!